how to legally avoid taxes. Listen, first and foremost, no, it is not legal advice. It's not tax advice. I'm not an attorney. I can't be an attorney. I would never be an attorney. I can't give legal advice. I can't stress this enough. It's completely outside of my purview. All I can speak on is the things that I know, and I can speak on the things that I've done. That's it. So I want to be very, 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 very clear. This is not legal advice, tax advice, relationship advice. This is for informational and educational purposes only. Information, education. The foundation is an educational firm. It's educational. I can't stress that enough. But having said that, 100%, this is how the wealthy do it. This is how savvy entrepreneurs do it. Shout out to Yusuf L, High Frequency Radio Network. And no, I am not a lawyer. Not a lawyer. I can't give legal advice. I have never given legal advice, and I never will. I've never given tax advice, and I never will. I've refunded people's donation, their payment for a consultation, gotten off the phone, given it back to them because I just cannot. I understand who I am. I understand who I am not. I understand in what capacities I can act and what capacities I cannot. This is important. But having said that, we're about to get into it. Get your pen, get a pencil. If you have a laptop, I know you have a cell phone, but those are small screens. Even if you got the Pros and the XLs and the Maxes and, all that dancing. But I'm going to give you a couple seconds. Get ready. Welcome to the foundation. My name is Sot L, Seeker of Truth L, Speaker of Truth L. And we're just going to get right into it. Pancake and toes. Gurus need to go to sleep, lay down. This is real stuff that we're talking about here. This is actual jurisprudence. So having said that, let's jump into this. Please be certain to check out welcome to thefoundation.com. Sign up for the email list. We have exclusive offers, events, entertainment, so on and so forth for people on the email list. We really appreciate y'all. If you are new to trust and trust administration, I suggest you start here. We have the Foundation Trust Primer right here. It's over 18 documents handpicked by me. A lot of people say, where do I start? You know a lot about trust. The way you talk, I can tell. You know a lot about trust. I want to get to where you are. Where do I start? I've been asked that a lot of times over the years. And this is my answer, the Foundation Trust Primer. You can grab that. We also have the Foundation Trust series, part 1, part 2, part 3. I would say part 1 is beginner, 2 is intermediate, 3 is advanced. And these are, concepts as well as education, specific education. So we can get right into it. Otherwise, that it will lead you up to trustee training, or you can jump straight into trustee training. We have a lot of documents, PDFs that we saw being charged for all over the internet. Not necessarily with regard to trust, but I don't know. Maybe you're into free information, or maybe you're into having information available. There you go. We have that for you, but that is welcome to thefoundation.com. Let me move on. As I was saying, we have the most comprehensive trust administration education available, period. People want to sell you trust documents. You don't know what to do. The IRS sends you something. The state sends you something, so on and so forth. And you're confused. You can't get a hold of them. They want to answer the phone. The phone number is not the same. It's disconnected. Some woman named Jenny picks up. and has no idea what you're talking about, and it's a real situation, I would highly suggest that you learn how to administer a private trust, a private structure, so that not only you can actually do that, administer the private structure, but that you can teach your successors how to administer and add on to it and benefit from it. We call it the family trust over here. There are also other trusts, business trust, things known as business trusts. Quote, use air quotes. At the end of the day, they're all trust, asset protection trusts. All of the above, you will learn not only how to administer them, but how to create them. Link in the description. If you are interested, you can start your business. Yes, you can. I believe in you. I'm not even joking. All jokes aside, I believe in you. It's what's necessary. Believe, begin, become. I know this because I did this. Believe, begin, become. So I believe in you. Believe in yourself. You can start your own business. This is the course for you. Link in the description. It's probably a little too much than what you need. I mean, it's very simple to start a business, especially, in the public. You're talking to LLC or corporation. I don't think it's difficult, but that has to do with, comprehension, I guess, of what I've studied. This is stuff that I know, so maybe it's just easy for me. But link in the description if you're interested. You can start your own business. Learn at your own pace. No tests, no quizzes, nothing. I would say the test is when you open your business checking account at whatever financial institution you choose, and you walk out with all the documents and the account numbers and the first couple 3 checks that they give you without the actual name of the business on it in the top left corner. That's the test. And when you do that, you pass. Same thing with trust administration, I believe, as far as the trustee training. Last but not least, we have the Foundation magazine. I always say it's luxurious because it is. And I'm not, just biased. Of course I'm biased. Of course I am. But it is dope. I would like to think that, the foundation, we can't, bring any negativity to the good character of the name of the trust. So I trust that this production, this magazine, is in line with that. I feel it is. I think that's what it's all about. What matters to me. We have a digital subscription, digital edition, digitally slipping over my own words, rendition, and we have a print edition, aka a print subscription. Link in the description if you are interested. It's up to you. Definitely want to say peace to all the subscribers. This thing is picking up, and I think people are seeing the value. So with that being said, let me start off by saying this, because this is the how to legally avoid taxes. Trust. Put the answer in the question, even though it was a statement. Trust. It's the name of the, it's the name of the, what you're watching. So what I do want to say, once again, I'm not a lawyer. I'm not giving legal advice. I know you're tired of hearing it, but I have to be clear. And listen, this is stuff that you don't want to just jump out the window and just start doing this dance if you have no idea what you're doing. Trust administration requires study and education and application of what you learn, not just what you think or what you were told. Very important. It's not what you think, and it's not what you were told. It's what you learned, and it's what you can substantiate, what you can prove through at the most. I would assume, in my opinion, the most crucial proof is a Supreme Court citation or something of that nature with regards to these structures. Now, before we get into this, I do want to say this. I'm going to use I'm going to call them official sources through all this. This isn't conjecture, theory. I don't get into that. This is Sot, seeker of truth. I don't care. what it sounds like, looks like, smells like, tastes like. I want the truth. And then I'll speak it, speaker of truth. So I use official sources, IRS. That's what we're going to mainly go on. And then I'm going to tell you the other source is going to be a law firm. You'll see. But this isn't my documents. This is stuff I made up. This isn't Photoshop. This isn't theory coming off of my mind. I'm going point by point. And I'm going to do my best not to go real fast. You know what I mean? Because I think this is important, but I don't want to take too much of your time. Right? Because, time is valuable. And I don't think this stuff needs to be overcomplicated. I think the people who overcomplicate this stuff, they just want to sound smart or lord over someone else with regards to, the powers and prowess of their intelligence. I don't know. I don't understand it. But we're going to hit this, this straight like an arrow. Straight up. So, when I say legally avoid taxes, trust, most people, I think, would expect things to be mentioned, like, retirement accounts, do a retirement account, an IRA, individual retirement account. I did that. Not going to lie. It was a while ago. Some of the first things you hear. Well, I heard health savings account, HSA. I even heard like a home office deduction, things of that nature. But what I'm going to tell you, and hopefully how I break it down, is not only something that you've never heard before, hopefully, and those of you who've heard it before, hopefully it's a way that you've not heard it. So I put it in a way to where you've never heard it articulated in such a manner. If not, I apologize for wasting your time because, you know more than I thought you did. And maybe I should stop doing these shows because people know this stuff. They're just tired of hearing about it. I don't know. I have a strange sneaking suspicion that a lot of people don't know this stuff. So I'm going to make it as simple as I possibly can. All right. So we're going to start with the IRS. So let's jump into the IRS, right? And I'm going to start with business structures. So if you go to the IRS website, right, and you went to this search box right here in the top right corner, and you typed in business structures, which is obviously the heading of this page, right? This is what you would get. I'm going to read this, right? And this is why I feel like people don't know this stuff. Because, you can search for, types of business structure. You can be Googling, just Googling for days. And this is really what a lot of people come back to. Excuse me. Because this is right here, the official source, right? So let's read this real quick. And remember, I just want to point out not only the grammar, but the specific words that are being used, right? So when beginning a business, you must decide what form of business entity to establish. Your form of business determines which income tax return form you have to file. Here we go. Check it out. The most common forms, not the only forms. And this is where people get confused. And to me, it breaks down to like simple language. And like, here's a good test, right? Communication, comprehension and communication. Here's a test. Ask someone, do you know what time it is? And I bet you right now, you probably looked at your watch, right? But I bet you, if you ask like 10 people, do you know what time it is? They will tell you the time. Straight up. Check. They will tell you the time. If you have someone who says yes or no and just looks at you, they have a superior comprehension. I'm just going to tell you that. And they have, I would say, the courage to actually give the correct answer. There was a CIA experiment. They brought like 19 CIA agents in there. One regular Joe showed a triangle to everybody, had everybody say one at a time what they saw, but they had all the agents say first, and the agent said square. And they got to the regular Joe, and the regular Joe said square. Look it up. I can't remember the name of that. It was like Project something, I think, or something. But listen, comprehension is huge, huge. And really, the best way to comprehend something is just to slow down. So the most common forms, not the only forms. This is not inclusive. I'm sorry, this is not exclusive. It's not excluding other forms. The most common forms of business are the sole proprietorship, partnership, corporation, and S corporation. A limited liability company, LLC, is a business structure allowed by state legislature or state statute. Legal and tax considerations enter into selecting the business structure. Of course they do. And then, here they go. Sole proprietorship, partnership, S corporation. And here's what I'm going to tell you right now. All of these owe their existence to state statute. It says right here, LLC is allowed by state statute. Sole proprietorship, it is a federal distinction. I will say that. I'm not giving legal advice, tax advice, none of that. But I will also say that a sole proprietor is a disregarded entity. Look it up. Partnerships are definitely, in a lot of cases, separate and distinct legal entities, corporations, S corporations. Excuse me, I think an S corporation is a specific designation. I think that's IRS Form 2553. That's just off the top of my head. That's the form off the top of my head. Y'all can look it up. But this here, I feel like is important, right? This is important. The most common forms, not all the forms, not the only legal forms. You understand? Moving forward, still not the IRS, right? Definition of a trust. This is on the IRS website. In general, a trust is a relationship in which one person holds title to property subject to an obligation to keep or use the property for the benefit of another. This one's funny. A trust is formed under state law. I would agree with that. And you'd be like, so what? Most people would be like, what? And anyone in the audience that follows the foundation or has followed the foundation for any time, you're probably very, very interested in why I would agree with that. That's crazy. I'll tell you in a little bit. I promise. I won't forget. I will tell you in a little bit. And I will bring it back. Now, in general, a trust is a relationship in which one person holds title to property subject to an obligation. Title to property, shares in the company's property, interest, membership interest in LLC is a property. Look it up. This is, the wealthy and savvy entrepreneurs who are on their way to being wealthy. Understand this. I promise. But I could be crazy. You never know. I could be, they could have just let me out for my little, I get an hour where I can use, stuff. And then I got to go back into my, straight jacket room with the bed and straps and stuff, with the padded doors. Who knows? So don't take my word for it. I'm not taking my word for it. We're in the IRS. Abusive trust tax evasion schemes. Questions and answers. IRS still. What is a trust? A trust is an entity created and governed under state law in which it was formed. under the state law in which it was formed. A trust involves the creation of a fiduciary relationship between a grantor, a trustee, and a beneficiary for a stated purpose. A trust may be created by any of the following methods: by declaration, transfer, and exercise of power to appointment to another person. Who is the grantor of the trust? The grantor, also known as the trustor or the settlor or the creator, these are synonymous terms, is the creator of the trust relationship and is generally the owner of the assets initially contributed. You know, I like this word generally. I think generally, when the Internal Revenue Service uses the word generally, you should generally pay attention. Generally. It's not an exclusive term. Listen to me. Generally is not an exclusive term. I can say generally it rains on Tuesday. And I would be telling the exact truth. Even though it rains on every other day, I could say generally it rains in the evening. Listen. Generally establishes in the trust instrument the terms and provisions of the trust relationship between the grantor, the trustee, and the beneficiary. These will usually include the following: the rights and duties and powers of the trustee, provisions, ability of the grantor to amend, modify, revoke, or terminate the trust agreement. Ooh. I want to point this out right here. Ew. That gives me an itchy, prickly feeling. This one also gives me an itchy, prickly feeling. The designation of the state under which the terms and provisions of the trust agreement are to be governed. Gets into what a beneficiary is. I like this. What is a simple trust? A simple trust is a term used in the Internal Revenue Code to define a trust that is not a grantor trust or required to be treated as a grantor trust, is required to distribute all income annually. It's required. And does not distribute the corpus of the trust or make charitable contributions. Ooh, sounds restrictive. Let's go to a grantor trust. I'm going to skip that because that didn't, you'll see. Grantor trust is a term used in the Internal Revenue Code to describe any trust over which the grantor or other owner, that's a specific word, retains the power to control or direct the trust's income or assets. That's a lot. That's power. Examples of the power to decide who receives income, the power to vote, or to direct the vote of stock. What are revocable trusts? An irrevocable trust is a trust which by its terms cannot be modified, amended, or revoked. For tax purposes, an irrevocable trust can be treated as a simple trust, a complex, or grantor trust, depending on the powers listed in the trust instrument. Pay attention. They're not lying. A revocable trust may be revoked and it is considered a grantor trust. You understand what I'm saying? Powers, depending on the powers listed in the instrument. And that's why I said, where was that at? Oh, here it is. Ability for the grantor to amend, modify, revoke, or terminate the trust. That's one of those powers. Definitely one of those powers. Wow, we got all the way down here. We're moving. A revocable trust may be revoked, I'm saying it again, and is considered a grantor trust. State law and the trust instrument establish whether a trust is revocable or irrevocable. If the trust instrument is silent on revocability, then most states consider the trust revocable. Silent. I like that because that kind of hints to law. They're acknowledging it. If the trust indenture doesn't say anything, then most states consider the trust revocable. Interesting. Very interesting. What is a complex trust? A complex trust is a trust that is not defined as a simple trust or a grantor. Or a grantor trust. Every time I read this, and I've been reading this for a long, almost every time I read this, I either laugh or smile or smirk or scoff or something, because this is funny to me every time. Do you see how explicit, and not even necessarily explicit, but how voluminous this answer is, and how voluminous or voluminous, I don't remember how to say it, this answer is. But look at this. It's one line. It's one sentence. Very interesting. Is there anything else that we should look at in here? And you guys can look this. I would suggest that you look this up and study this, because I would say this: when it comes to private trust administration, and furthermore, maybe more, even more specifically and more appropriately, I would say, when it comes to private trust education, I always say, if you're not taught, if the trustees who are learning, I call them trustees in training, if the trustees in training don't learn or pick up or have confidence, and this, of course, comes with their own study. They have to read. They have to do their part. But within the training itself, if the trustees aren't competent and don't feel competent to survive an audit from the Internal Revenue Service, there's a problem. There's a problem with the education. There's a problem. And if there's a problem with the education, there's going to be a problem with the administration. And more specifically, there's going to be a problem with the ability of the trustees to protect not only the good name of the trust, but the property of the trust. And when I say property is voluminous. I'm going to just keep, that's my word tonight, I guess. Property is it's a very encompassing term. I'll say that. It encompasses a lot of things. You look it up in a law dictionary, preferably a Black's Law 4th edition. You can do a 7th edition, and the 8th edition and the 6th editions are good too. But I like the 4th edition, and they're very expensive. But any law dictionary, look up the word property. You know? So, let me keep going real quick. Is there anything else? Testamentary, inter vivos. Inter vivos is while you're living. A testamentary trust is created by will. Inter vivos, that's a living trust. It's a grantor trust. Living trust. A living person creates an inter vivos trust during the person's lifetime. An inter vivos trust can be established as a revocable or irrevocable. An inter vivos trust can be simple, accomplished, or grantor trust, depending on the trust instrument. And you see how the IRS, again, defers to the language in the instrument. Very important. Does a trust have to have the requirement to file federal income tax returns? Trust must file Form 1041. For each taxable year where the trust has $600 in income, or the trust has a non-resident alien as a beneficiary. However, and check this out, this is important. If the trust is classified as a grantor trust, it is not required to file Form 1041. Why? Provided that the individual grantor reports all items of income and allowable expenses on his own Form 1040, the original individual form. Ooh, that's what I'm saying. That's a grantor trust. How does a trust compute? Must trust deduct contributions, charity, well, federal gift taxes. Yeah, gift taxes. The language that you use when you're corresponding with the Internal Revenue Service on the behalf of a trust in your fiduciary capacity is very, very important. Language is important. Can I get more information? One more. So this one is common law trust. Contrary to claims of promoters, common law trust no longer exists since all states now have statutes relating to creation and operation of trusts. I would say that I would agree and disagree with that statement. I don't think common law trusts ever existed. Ever. The common law provides no trusts. Common law is not even written. I mean, some common law is codified in statutes, but common law and trust. I mean, listen, let me be specific. And I want to be specific for everyone who's checking this out, because I don't want any of y'all to be ignorant and if you are ignorant, you will sound ignorant when you speak on topics that interest you, such as trust and trust administration and legally avoiding taxes. And I'm not a legal advice dude. I'm not a tax attorney dude. I'm not an attorney dude, excuse me. Right. But I want you to comprehend. There's no such thing as a common law trust. And I'm going to tell you how in a minute. I know, I'm sorry. I'm sorry. I'm kind of trolling. Understanding tax impacts of distributions. Wait, hold on. Common law trust, foreign trust, personal residence trust, qualified personal residence trust, grantor retained income trust, grantor retained it. I feel like there was something I want to talk about in here. Charitable life insurance trust, qualified funeral trust, rabbi, peer trust. The term peer trust is not used in the Internal Revenue Code. They talk about Delaware business trust. You should really check this out. Charitable remainder trust, grantor retained. Okay, so qualified. There was something I want to say. Foreign trust. Those who talking about that 9A number, check this out. Y'all should check this out. Personal residence trust, qualified personal residence trust. You should check this out. But let's move forward. And then I'm going to wrap this up. I apologize for taking all your time, but I do want you to, look, that was the IRS talking. 100%. This is Miller Grossbard Advisors LLP. This is some sort of, they a firm. They a firm in Texas, Houston, Texas. And I'm going to tell you, Texas, I flew to Texas to mentor apprentice under my trust mentor. Rest in peace, Mr. Franklin. But yeah, Texas is that dance. I can't say I'm from Texas. My father's from Texas. I've spent a lot of time in Texas. I'm very familiar with Texas, specifically Texas. And I'm just gonna say Texas is that dance. So I'm not surprised it's a firm from Texas. Understanding tax impacts of distributions from a complex trust. A simple guide. This is a simple guide. This is not me. I'm not an attorney. I won't say it again. I might. They got this thing right here. And look, imagine you and your siblings are set to inherit a substantial investment portfolio from your grandparents, with your parents acting as the trustees. So your grandparents are the grantors. The trustees have the authority to distribute portions of this portfolio to you over time. So that would probably be spelled out in the indenture. That schedule will be in the indenture that the grantors, wrote out. Suppose your parents decide to release some of these assets to you now rather than later. This process seems straightforward, but there's a twist. Each distribution carries a potential tax obligation if the assets of the trust are generating taxable income. The question then arises, who is responsible for paying these taxes? The trust managed by your parents or you and your siblings directly? The scenario described above is generally referred to as a complex trust. Y'all, there it is. Why isn't the Internal Revenue Service just defining the term complex trust as they define? Hey, a complex trust is a legal entity whose assets are managed by a trustee or trustees on behalf of beneficiaries. The trust assets often generate taxable income. The trust assets could be membership interest in the LLC. Y'all, start a business. Corporation shares. Start a corporation. I don't care. There's ridiculous tax write-offs for starting businesses and operating businesses. Operating, not owning, operating. You understand what I'm saying? Language is very important, y'all. Tremendous. But, all of these things, there can be intellectual property that the trust holds. I could tell you right now, The foundation has a lot of intellectual property, a lot. It's just how we think about things, how we process things, value things, and the specific language that's being used. A complex trust is a legal entity whose assets are managed by a trustee on behalf of beneficiaries. The trust assets often generate taxable income. Understanding who gets taxed and how, after a trust makes distributions to beneficiaries, can be complex. So let's break down it into simpler terms. Taxation of trust income. First, it's important to understand that trusts, like individuals, can accumulate taxable income. And anyone who tells you, some guru with some weird feet, they're probably flat because I pancaked them, I stepped on their toes. If they tell you that, oh, it's this private trust, this pure trust, whatever trust they say, Massachusetts trust, whatever, doesn't have to pay taxes, doesn't have to file a return, those fools are crazy or woefully uninformed, and you should back away. Don't turn your back on them fools. Back away. Because I would lean more towards them. They're crazy. That's it. I'm serious. This income can, and that ain't tax advice. That's just real. This income can come from interest, dividends, capital gains, or other types of income from assets owned by the trust. Normally, this income is taxed at the trust level unless it is distributed to beneficiaries. Trusts reach the highest tax brackets at a much lower level of income compared to individuals, so there may be tax-saving incentive to distribute income to beneficiaries who may have lower taxes. And this is a lot of things. People, may get a consultation with me and stuff, and one of the first things they say, if they're doing their research outside of, hey, why would I be the trustee if, I'm told that I'm supposed to be the beneficiary or the grantor? That's one of, and the other one is the trust tax rate is really high. Why? What? And they'll understand, right? This complex trusts can distribute 100% of their taxable income to their beneficiaries and therefore owe no tax. And they're like, well, why would I want to do that? I'll tell you in a second. The mechanism of distribution. When the trust makes a distribution to beneficiaries, two key tax events happen. Pay attention. This is not me. This is MGA. Y'all need to call them if you got a problem with this. Tell the IRS. They telling the business. They're putting it out there. They try to hide it, but they're putting, look, income distribution deduction for the trust. The trust can take a tax deduction for the income it distributes to the beneficiaries. This lowers the trust taxable income, resulting in the trust paying less tax. Instead, the trust is passing the responsibility of paying taxes on this income to its beneficiaries. In this scenario, they're talking about the children or grandchildren. And number two, pass-through of income to beneficiaries. The beneficiaries each receive a Schedule K-1, which reports their share of the income distributed from the trust. K-1 is distributions. 1099 is contractor income. A lot of people will do 1099 in their own name, in the individual name. Oops. And then what was the other one? W-2, that's from employment income. There's different types of income. K-1, distributions. Beneficiaries must then include this income on their personal tax returns and pay the necessary taxes according to their individual tax rates. Here's an example. Let's say the trust earns 10 grand from dividends and interest. They can, could be from anything. That's why they're trying to hide it, from dividends and interest. So you don't look at it. The trustee decides to distribute $6,000 to the beneficiaries. Here's how the tax situation works out. Because I want to say, do you think because it's a trust, then it can only receive income from dividends and interest? That's the question. Is that the exclusive manner by which it can receive income? The trust earns $10,000 and distributes $6,000. It can deduct $6,000 from its taxable income, reducing the amount on which it needs to pay taxes. The trust will only pay taxes on the remaining $4,000. The $6,000 of income distributed is reported to the beneficiaries according to the amount received by each beneficiary. Each beneficiary will report their share of the $6,000 on their tax return and pay the appropriate taxes. That's true. If this is, if the instrument calls for this type of distribution. Now let's stick with the same example of a trust earning $10,000 in a year from dividends and interest. This time, the trustee decides to distribute $14,000 to the beneficiaries. Here's how the tax situation would be handled. Trust earns $10,000, chooses to distribute $14,000. Out of this distribution, only $10,000 represents the income earned by the trust for that year. The trust can deduct $10,000 of the income it distributes from its taxable income, which effectively reduces its taxable base to zero. Did you read that? Did you read that? I don't care what you're talking about. I don't care if you're talking about interest, if you're talking about dividends, if you're talking about grandparents. Don't pay attention. Did you read? I'm going to read it again. Did you hear me? You can just close your eyes. Just close your eyes. Just listen to me. The trust can deduct the $10,000 of income it distributes from its taxable income, which effectively reduces its taxable base to zero. And my mentor used to say, I don't know what you're talking about with this Patriot stuff. I don't know. I've seen these, what do you say? What are they called? UCCs? I've seen these UCCs and these 9-8 numbers. I don't know what you're talking about. I work for a firm that restructures organizations internationally. And if you're restructuring organizations internationally, you have to know what type of structures that can operate internationally. Man, and my eye went bing. I didn't write him a check, but he got the wire. He got the wire because he was spitting that game. The game. It was Raw Daddy. I'm gonna read it one more time because this is cold. And I just, look. The trust can deduct $10,000 of income it distributes from its taxable income, which effectively reduces its taxable base to zero. Excuse me. Pardon me. You can't do that with an LLC. You can't do that with a partnership. You can't do that with an individual. You can't do that with a sole proprietorship. You can't do that with a, you feel? You see where I'm going, right? Put 2 and 2 together. That's all. I'm not giving legal advice, tax advice. This is educational purposes. Did you know? Huh, that's interesting. Did you ever think about it like this? I'm not saying what to do, what you can do. I'm reading this from the attorneys. These are attorneys, man. Call them. They even got a thing. They got a client portal. You can pay your invoice. Look at the top right of the screen. Client portal. Pay your knowledge center. Let's talk. Careers. Our team. What we do. Why this matters. Understanding this mechanism is crucial for both trustees and beneficiaries. Trustees should consider managing distributions efficiently to minimize overall tax liability between the trust and the beneficiaries. I'm going to tell you right now, you get in the trustee training, that trust indenture specifically states that the trustees are supposed to administer the trust in a way that it does not incur a tax obligation. Beneficiaries should understand how and why they're being taxed on distributions, as this affects their personal tax planning. Making distributions from a complex trust doesn't just shift assets from the trust to beneficiaries, it also shifts tax responsibilities. This system allows for potentially lower overall taxes on the income earned from trusts' assets, benefiting all parties involved if managed wisely. Now check this out. What if the trust owns most of the interest of the LLC? Let's just say that, right? And the trust receives the profits from the LLC. Ooh. That's an interest, right? Next time you consider the implication of receiving assets from an inherited investment portfolio or trust distributions, they're talking about you receiving it. Like it's already set up. We can help you figure this out on how you want to get that money. This is what these attorneys are talking about. But their grandparents talked to my mentor and his mentor to get set up. But if you're distributing straight to the beneficiaries, the individuals, that's the key. Now, I told y'all I was going to get to this, right? What's the point? The point, the biggest point and caveat of everything, all of this, is that you must comprehend that Article 1, Section 10 of the United States Constitution states in part that no state shall pass any law impairing the obligation of contracts. So if the trust is cast from the jump, from the first step, if the when, let's just say when, because I don't like to speak in ifs too much. When a trust is cast, actually, when the trust is cast, but the substance of the trust is a contract. And this specific contract and those drafting, the grantor or grantors drafting the contract, understand that jurisdiction, state jurisdiction, being invoked is a problem and should and can, which is most importantly, can be avoided. We saw multiple times where the IRS even deferred to the contract first. They called it the instrument. They didn't say the contract. They wouldn't be so bold as to say that. There's no such thing as a pure trust. Technically, when I say private trust, I'm speaking in code. There's no such thing as a 9(8) trust unless 9(8) trust is in the name. There is, hold on, let's go back. Let's go back. Abuse of trust was at the top, right? We got the definition, business structures. Common law trust. There is no such thing as a common law trust. I was trying to remember that. That's the one I was trying to remember. There's no such thing as a common law trust. I agree with them. It is a contract trust, y'all. Write this down. It is a contract trust. And it owes its existence to the laws of contract, not to state law. It is a contract cast in the form of a trust. So if you have the right trust indenture, you have the right trustee education, it is not difficult. It is not difficult. It is not difficult to successfully defend an action from the state revenue service. Why? Not giving legal advice, but these types of trusts do not file state returns. Why? Because they are not created, nor do they owe their existence to state statutes or state legislation. They owe their existence, and here we go, to the common law right to contract. We have the common law right to contract unlimited. And with regards to that right, we can contract anyway. And if you know how to, and you know how to administer, you can cast a contract in the form of a trust. And it's not a trust issue. Listen, it's not a trust issue. It is a contract issue. That's the difference. State statutory trust, any trust that owes its existence or invokes state statutory jurisdiction cannot avail itself of the contractual protections provided in the Constitution. It's that simple. Period. Listen, anyone who makes it more complicated than that. And of course, there's administration and there's a thought process. You got to switch from can I, which is most of y'all's mind state, to how can I? Most of y'all, all of us, I used to be this way too, where we were conditioned to ask permission. Can I do this? Can I do that? Can I do this? Can I do that? That's in a system where we have limited control. With the right contract, the trustees have ultimate control. And in your fiduciary trustee capacity, I say that we are equivalent to executives and or owners. You don't walk in the door and talk to executives. You don't call the phone and talk to executives. You have to know the right extension, so on and so forth, and they possess a more distinct, cogent, and volume of knowledge with regards to, the function of that business, as do I, a fiduciary trustee. I've studied this for years, and I feel like that has contributed to my ability to break it down the way I do. No, there is no such thing as a common law trust. Don't want to hear it, man. I correct every time I hear it, and if I'm invested in you, I'll correct you. I'll be like, listen, man, it's not a common law trust. You have the common law right to contract, unlimited, so it can be a contract trust. Which owes its existence to the laws, the common law right to contract. But it is not a common law trust. These are schemes. These are gurus trying to make money. These are gurus who don't operate in trust. They don't have their estate set up in trust. They don't have, when necessary, the trust checking accounts. They don't know how to do it. They don't have the trust brokerage accounts. They're not titling assets in the trust. Their vehicles are not in trust. Their property is not in trust. They've never been pulled over. And the officer says, "Is this your car?" And they say, "No, it is not my car. It belongs to a trust and I am the trustee." These are gurus. Watch out for the gurus. But I'm seeker of truth. And if you're interested in hold on, let me back up, right? Because there's one thing I almost forgot. Complex trusts. The trusts that the IRS doesn't really want to talk about anymore, Where's that? Where'd it go? There it is. What is a complex trust? A complex trust is a trust that is not defined as a simple trust or a grantor trust. I could have deduced that just by looking at the name. If it has a different name, then it is not this one or this one that has other names. And I feel like this is the stuff that if you're reading fast or if you're not reading at all, you don't pick up on this stuff. But I will tell you this. A complex trust can be a grantor of a trust. It can be the trustee of a trust. It can also be a beneficiary of a trust. And trusts, they take their allowable expenses according to the trust indenture, not statutes, not the Internal Revenue Service. The Internal Revenue Service cannot define what an allowable expense is with regards to a contract trust that has not invoked the United States or state jurisdiction. Trust me. And what's left over, a complex trust can pass its taxable income to its beneficiary. And said beneficiary could be a complex trust itself. Correct? Yeah. And it could take its allowable expenses according to the contract indenture. And you see why they said effectively reducing the taxes to zero effectively reduces its taxable base to zero. My mentor used to say effectively reduces their taxable income to zero. He would say 15%, 10%, 3%, and then sometimes 0%. And here the attorneys are saying the same thing. That's how you do it. If you can put together what I just said, which wasn't difficult, there it is. People pay thousands and tens of thousands of dollars to be taught the concept of what I just shared for you. I'm sorry, shared with you or for you, both. Just for that concept. Rewind it, download this, save it, whatever. and review this, because conceptually, I just broke it down. This is why the elite in the world get richer every generation. This structure. And then there are concepts and specific systems applied to these structures. Private family banking, endowments, private family foundations with our tax exempt. My mentor used to say, I don't care how much money you make. How much did you keep? I used to watch people's faces change. I say the same thing. Watch their faces change. And I'll tell you the truth, because I'm Sot. I didn't come up with that question. My mentor did, Mr. Franklin. But there it is, y'all. If you're interested to learn how to administer a private trust, there's a link in the description, y'all. And this is why we're like, listen, you start your own business. Why? Because employees, you can't do this, because you cannot assign income to a trust. You cannot, whatever structure, and I say the individual is a structure, whatever structure receives the income must be responsible for the tax. So employees, and even if you're an employee, you got a really good job, right? Just still start a business. There's not a cap. There's no maximum wage. There's a minimum wage. There's no maximum wage. It's all about what we do. And you can better your life and have fun. Start a business you like. Don't start, this makes money, I'm gonna sell these little clips. They're blue and whatever. If you don't enjoy it, what's the point? Have fun with it. How can I? That's the question, y'all. But link in the description, the most comprehensive trust administration training. You cannot buy a trust indenture from the foundation since its inception. You cannot. So let me get a trust, man. Let me just buy it. I'm not doing it. Oh, man. Here's why. I'm going to tell you why. 2 reasons. Education is a non-regulated activity. The government has to stay out of it. It's non-taxable. It's a charitable activity, actually. The foundation isn't a for-profit business. It is a non-profit. It's a private, not-for-profit educational firm. So we teach trust education in an educational format. This is not a transactional format. It's an educational format. You're purchasing education. You're learning how to create the trust indentures that you're trying to buy, as well as you're learning how to administer them, how to protect them, how to pass them on to your next generations, and how to utilize them to, let's read it together. Effectively reduces its taxable base to 0. It's not even patriotic to increase one's taxes. Supreme Court Justice said that. Off the top of my head, I can't remember who it was. So like I said, link in the description if you're interested. If you're not, it's not for you. You probably didn't even listen this far to this episode. But for those who have been looking and, like a thorn in your mind for years, maybe since you can remember, or maybe just recently, there's a thorn in your mind and you just can't, something's going on and I just can't place my finger on it. Welcome to the foundation. My name is Sot L. And it would be my pleasure to serve you and your family. Link in the description, y'all. I would like to thank you for checking out the show. I hope you learned something. I trust you learned something. I trust that I excelled in my fiduciary responsibility with regards to this show, how to legally avoid taxes. Trust. My name is Sot L, seeker of truth L, speaker of truth L. I am not a lawyer, not an attorney. I don't give tax advice, nothing. I can speak on what I know, and I can speak on what I've done. And I can also speak on what I've seen. Outside of that, I ain't trying to get nothing from you. I'm just trying to see what you get from yourself. I appreciate y'all. Hit me up if you have any questions. Admin at welcometothefoundation.com. You know, I'm pretty good with the spam at these days. If you would like to book a consultation with yours truly, still, they try to get me to, raise it up because there's a board of trustees here at the foundation now. They try to get me to, but listen, the consultation is $55 an hour and we usually go over. If you want to book a consultation, go to the website, welcometothefoundation.com, scroll down to services, and just under services, just above education, book a consultation. You can put your email in and your name. It'll hit you with a PayPal invoice for 55 bones, and we can talk about it. We can talk about your situation specifically. But as always, I don't give legal advice, but we've helped hundreds of families at this point. I can honestly say that. And hopefully yours is next. But y'all take care of yourself. Enjoy yourself. Make sure you say 10 things that you're thankful for before you go to sleep tonight and every night. It's very important. And I'll catch y'all tomorrow on current events. For real. Peace, y'all.